Right? How's it going, everyone? Welcome to the Proving Ground Mastermind. We're going to get started here in about 2 minutes or a minute. So if you guys have questions, feel free to chat those questions in. And if you can chat in and let me know if you can see my screen and hear me talking as well, that'd be helpful. Ron, I think last time I checked it, it still wasn't. Hang on one second. Let me check just to make sure before I. Let's see. There it is. So this is what it shows me when I try to pull it up. So I go to the link you sent me, and it still says it's unavailable. So this video is private. So what I have to do usually to set it to public is if I go into a video. So let's say I go into this one, and right here, so if I set it to private, then no one except I can watch it. But if I set it to unlisted, then I and anyone else that has a link can watch it, but it's not necessarily going to be something that is easily found on YouTube or anything like that. So if that's your intention, I would say just make it unlisted or even public, whatever you'd like, and then resend me the link. I don't know if the link changes when you do that, but yeah, I appreciate you sending that to me, man. Sorry it's been a bit of a hassle. But I appreciate your dedication to sending me that video. I really do, so thank you. All right, awesome, guys. Let's go ahead and get started. Appreciate you guys being here. Welcome to the Mastermind. As always, like, share, and follow on social media, facebook.com/daytradesmart, instagram.com/daytradesmart, and the number 1, youtube.com/the proving ground. And if you guys have questions beyond that, of course, you can always email us at info@daytradesmart.com. All right. So what we're going to do today, thank you, Andre, appreciate that. What we're going to do today is I want to kind of go over some pressure stuff with you guys. I noticed that a lot of you guys are focusing on the pressure indicator lately, which I think is great. And so I want to kind of give you guys a few extra tips. And this is something that I want to continue to do. I feel like, you know, we need to get to a point where we're making that concerted effort to get to a more discretionary way of trading. Because what I realized, especially through 2020, is that although, you know, you can still use your systematic approaches, there are things that become very evident in even your systematic approaches that could perhaps dissuade you from taking a trade, or even persuade you to take, you know, a trade that you wouldn't normally take, or position a trade, or whatever it may be, by some of these nuances. And so I just want to be able to, you know, bring these to the forefront, to put them in your space, so that when you guys are trading, you can start noticing these types of things. Maybe when you're evaluating your trades for the day or the week, you know, you can go back on them and see if there's anything that happens consistently with winners or losers, or you know, whatever it may be, trades that maybe, you know, you were in for a long time and probably could have positioned a little better, or whatever it may be, right? And a lot of times we can pick a lot of that up with pressure. Now, I want to be clear about something. All of our indicators work 3 different ways that I like to label them. Obviously, there's multiple ways they work, but 3 different ways in this particular scenario. Directional, right? The direction they point, and illogical and pattern-based, right? So logical is like major, minor, point up, it's time to buy. Illogical is major, minor, point up, it's time to sell, right? And obviously knowing the difference is important. Same thing with TNT, same thing with pressure. But one thing that's important to understand is that they are all capable of being reactive. Okay, that means that if the market just shot up, it's obviously not going to be uncommon that the indicators reflect that, right? And you've got all points pointing up. Oranges are up, blues may be down, major, minor up, pressures up, green on top, right? Everything looks good, right? And a lot of times that in and of itself, depending on the situation, means you should probably wait for some pullback before you continue in that direction, right? And other times it's, let's go full bore. But a lot of times when we see that happen abruptly, right, all of a sudden everything is pointed in one direction where before it was either sideways or pointed, the opposite direction. That's usually a result of something emotional, right? Other times it could be just the market open. So at 8:30 Eastern time during an announcement, or 8 o'clock Eastern time during market open, or 7 p.m. When some of the other markets open. And I was actually just talking to Chris Draper yesterday, I believe, and we were talking about that. Like 7 p.m. is kind of that oddball sometimes, especially on the Euro-US, where you can all of a sudden see volume and liquidity come into the market, and you get these big moves or these big swings all of a sudden at 7 p.m. at night. You're like, what the heck is going on? You look at, your economic calendars, or you look at, some news outlet, and you don't really see anything that would justify that. But what the justification really is just that the market opened in certain currency pairs, like the Japanese or Asian pairs, and so there's this influx of liquidity coming into the market. Chris says, yes, I had a really hard time finding winning ratios at 7 p.m. So that's 7 p.m. Mountain Standard Time. Yeah, thank you, Chris. So it'd be like 9 p.m. Eastern. But yeah, like 7 p.m. Mountain Standard Time. And that's because of that, right? So we obviously want to be cognizant of those things. But and so we're not necessarily going to talk about that today, but I wanted to show you guys some stuff in pressure specifically, and to be aware of. So you'll notice, let's look at this first example for a moment. And if we go back one candle, so we're looking at this chart here on the left, we go back one candle, we can kind of see, and there's some justification as to why it went short, right? For those of us that, like those reverse type scenarios where, the market is, maybe majors, faked out minors. I'll kind of show you. Let me go back another candle. So we go here, we can see that it's likely that at some point this is probably a hiccup pattern, right? We probably had green down, red up, minors crossed and touching or into the channel, green pressures on top, red candle. So we'd be speculating a long trade right there. And minors are obviously looking to short, right? If we go back, we can see that. So now we're going back like 4 or 5 candles. We can see that, and this is something that we know about minors, is that when they hit that 160, right, we know that that line is not going to be pointed up on the next candle. It never is. If once it's 160 or negative 160, that line will either be sideways or pointed down, right? But it's not going to be pointed up. So that's going to change direction, right? And that doesn't always equate to a short movement, right? Because it's, depending on what time of day, and it's the minors, and it could move a little bit short, maybe a pip or two, and sometimes it could be a full-on, retracement of the previous candle. But so I'm not suggesting that could be, in and of itself a trade setup, but it's good to know. In any event, we see that miners have kind of exhausted after having been overbought, right? And majors are still pressing on, okay? And then miners try to take the short, right? Majors persist, and in their persistence, kind of snap the backs of the miners. You can see there was some short movement, right? But then as it went up, we can see that we kind of got that back snapped from the miners, and now they're crossed up. Okay, and a lot of times that's a result of getting stopped out, not because they decided to buy. Right? They got stopped out. It hit enough of their stop losses that now those lines are crossed and pointed up after having crossed and pointed down. Right? And so that's kind of the fake out by way of the majors, and now we've got that double confirmation here, but we also have it here, or rather, sorry, I was thinking of another example, but we've got it here. So that right there, yeah, that could be some justification why we see some short on the next candle, right? Because we've got that double confirmation. But notice that when we get that, it's deep, right? We've got, let me erase this line. We've got small movement up, 3.1 pips, and then deep movement down, 31 pips, which essentially retraces, 5-6 hours of the previous candles, right? And so what retail traders call this candlestick, not that it's relevant to you guys because it's only 50% right, but it's a reversal candle. It's an H1. It's what's referred to as an H1 reversal, right? H1 represents 1 hour, and it's a reversal and it's a price action reversal because it has a higher high and a lower low. So if you guys know anything about price action, which is also garbage, if you have a lower low and a lower high, like we did here, right? A lower low and a lower high, then that's a sell indication. That's a short indication, which, by the way, a lot of times happens when we get a hiccup pattern, right? And we probably had one there. And that tells the miners to sell, and that's what they did, right? And then the majors pull up. Okay, and again, I mean, depending on what their stop or what their take profit was, they could have gotten some of it, but for the most part, they lost it because we can see that now these lines are crossed up, and that's usually a result of stop loss. But right here, we can see that this is, and so a price action buy would be a higher high, like this, and a higher low, like that. And that would be a H1 price action for buy, right? Now, when you have both a higher high and a lower low, okay, that's an H1 reversal, right? And that usually means, if this is a red candle, that usually means you're going to start seeing some short movement. If it's a green candle with a lower low and a higher high, then that usually means, up, right? And it's not an H1 reversal. It's just it's a continuation. But it's an engulfing, right? Because it engulfs the previous candlestick. Okay. And the only reason I'm explaining that to you is because we can see that the miners are sold out to this concept. But this happened very abruptly and was big. And a lot of times, we can see that things start to line up for us in those instances, right? Blue dotted up, thick blue up, thick orange down, thin orange down, majors down and entering the channel, minors down, and almost, and oversold. There's that 160, by the way, so we know that that's not going to be pointed down on the next candle. Pressure is now green, it's still on top, but now it's pointed down. But look at how pressure kinked in that scenario. Right, it was up, and there's divergence, which is, a lot of times you see divergence that's indicative of sideways movement, And really, in regular circumstances, we're looking at sideways of the body of this candle, 8.9 pips, right? So somewhere within there. It could be 1 pip, it could be, 8.9, it could be, more than that. But we're looking at some type of sideways a lot of times when we see that kind of stuff. But what we see instead, and you can see this green line's actually pointed up, red's up, but then we see this sharp kink, right? And sometimes, and I want to be clear, I'm not implying that this is some kind of trade setup or anything like that, but keep an eye out for these abrupt changes in direction, because these are, again, they're indicative of that reaction to the market. It's reactive, and reactive means it's just showing you what's already happened. It's not necessarily showing you what's going to happen. I prefer, and I'm sure the rest of you prefer, predictive. Tell me what is going to happen, or at least what's going to continue to happen, right? I can already see what has happened. So this green line abruptly changing directions and pointing down is a direct correlation with what just happened in the market. We had a sharp move down, and it created an abrupt change in the indication, which is telling you the market moved down. It's not always telling you the market is going to continue to move down or it's going to move up. It's just telling you that the market moved down. That's what it's telling you. The market moved down, period. So what do you do with that information, right? Well, if you experience this when you're trading and you start to see a correlation between this and success or failure, or if it's moot, obviously just leave it alone. It doesn't matter to leave it alone. But if you see a correlation between success or failure, then you want to go back and test that theory, right, and see if there's something there. Because a lot of times what will happen with these abrupt changes in the indication because of a reactive circumstance, you'll get pullback. Right, and sometimes it's very significant, and other times it's very shallow, right? But you'll get pullback, and so we end up getting sideways of the previous candle, right? And not always, right? But that's for you to determine, figure out how that works for you in the times that you trade. That only went down 2.5 pips. We already knew that miners were not going to be pointed down. We already knew that because it was at negative 160 right there, right? And then it moved back up. So let's say we wanted to take a short, right? Let's say we're looking at this and it fits our criteria, right? We've got we got 1 point, 2 points against, let's just say we're using all these as points. Maybe we're using a clean pressure chart, whatever it might be, right? And by the way, I don't even have to check, but if I looked, I can almost guarantee that on a clean pressure chart, let's say if we're looking at a 15-minute or even 30-minute or whatever, that the candle is going to be below the pressure lines and the green and red are going to be pointed down, even if green's on top, right? As we're going to likely see in that situation. And it could be that the last couple, minutes or whatever softened that, but for the most part, let's just assume that that's what it looked like if that was our strategy, right? But what I want you to pay attention to is this abrupt change in pressure specifically. Because a lot of times when that occurs, we get that pullback initial. Now, it doesn't mean that the market is not going to start coming down, and sometimes it may not, and even if it does start coming down, it may not be enough for you to take profit. It may not be beyond that, right? So from here, it could still come down, say, back to there, 6.5 pips. But if you're in here, you've moved 2.5 pips to that point. Let's say your take profit was 3 or 5 pips, right? So then your take profit is, let's just say 5 pips. 120.135, so it'd be 120.085. Right, almost. 0.8, and 0.83 would be including spread, but let's just make it 0.85. Right? So even if you move down from that candle, yeah, it moved down, but not enough to take you out profitable, right? And I know you guys have gotten stuck in some of this, or maybe it moves down from that point, right? But it still doesn't get you out enough to be profitable. and this one might, but just as an example, right? And actually it didn't. Let's go forward and see if maybe it does later. Not that it matters, but yeah, right here finally. So, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. 15 hours later, that's not a result of what you were seeing here, right? You got lucky. And I mean, really, maybe you didn't get lucky, depending on what your stop loss is, because it also went up, right? So, and this is just one example. This shouldn't serve as doctrine in and of itself. I mean, it went up 11.1 to that point, and then it went up 12, I think, at most. Let's see. Yeah, 13.2. So, it depends on what your stop loss and take profit are. But you get the idea, right? I mean, even if you'd have waited, to see if it was going to give you that pullback, you would have set yourself up in a better situation. Matter of fact, you would have been out likely right there, depending on what your take profit was, because you would have ended up getting in here, or maybe later on, maybe you positioned with even a 5-minute, and maybe you got out in this same candle, right? And again, it's not something you want to just try out in a live account. You want to practice it in demo. Make sure you got a good beat on it. Back test it. Make sure that you're seeing what's actually there, not just kind of making it up in your brain. But it can be really useful. And these are things that we use when we trade discretionarily. Those small nuances, right? And those don't equate the same when we're looking at a pattern. Why? Because the pattern says specifically, and we've talked about this, make sure yeses are yeses, noes are noes, maybes are noes, right? So does this have all the points to your setup? Yes, then you take the trade. And you should. Even if you've noticed something that has caught your attention, like what I'm pointing out today. Your setup is there, take it. That's what you backtested for. And you backtested with that parameter in mind as well. So take it. Take the trade. Okay? But if you do notice something, go back and look at those scenarios. Go back in your backtest, and you already have it. Go back to those dates and see, did any of those win or loss? Don't just look at the losers, right? Because if I just looked at the losers and I said, oh yeah, a lot of the losers have that, so I'm going to eliminate those, right? But if you look at the winners, and the winners also have that, and there's a whole bunch of winners that have that, then you could be creating harm for yourself, right? So you got to look at all of it. Look at all of them, and just look at the ones that, so winners and losers, but look at the ones that fit that criteria. You had an abrupt change in direction of pressure. I'm talking about pressure specifically for just today, okay? And see if there's any correlation. There may or may not be. There may be for most of you, and for some of you not. The only way you figure that out is to go and test it, right? So let's look at another one here. Now, if we go back here, we can see that we actually had that positive convergence. Now, and really, like if we look at this, let's go back on this one as well, because we kind of had the same thing going on here, right? We have almost a hiccup pattern right there, right? After becoming oversold. We kind of almost had that hiccup pattern right there. Minors are slightly crossed. I mean, you can counter if you want. It doesn't really look like it to me. And again, later when you become more discretionary, you can look at that and say, no, that's good enough. It doesn't have to be a pattern. I know what that's telling me. But if it's a pattern you're looking for, this is not, in my opinion, it's not a hiccup pattern. But we can see that we still get that fake out from the majors to the minors, right? And majors pull down right there. Minors start to soften to the short side. Green is now positively converging with red and continues to do so. And right here, we actually have that double confirmation. I mean, it's not very strong, but we still have it, right? Both of them are both pointed down after the fake out by way of the majors. And so, I think in some regard, we would expect to see some short there, or rather some long there. And we really didn't get much, but we didn't really get much to the short side either. And then we still kind of have that double confirmation. So right there, there is some justification there why we would see some long movement. But watch the abrupt change in pressure again, right? And it's a big candle. It's a big candle. I mean, we're retracing, and there was some sell there, right? 6.8, but it went 20.1 up, which retraced, 5 more hours, right? Let's just tighten that up. Actually retraced, from here to, even there is 22 pips, and this one went 20 pips, right? So all this consolidation, right, we kind of retraced all of that with one candle, right? And again, the indicators are being reactive, right? They're reacting to what's already happened. So they're telling us the market moved up. The pressure indicator is telling us the market moved up aggressively. That's what it's telling us. It's not saying it's going to continue to move up aggressively. It's just telling us that it moved up aggressively, right? We had that kind of down, and then boom, right there. We get that kink. Green is up, red is up. So we had that aggressive move up, right? And again, if we're looking at that from a very systematic, right, pattern type setup, we've got a lot of things going for us here. Thick orange, thin orange, blue dot, or thick blue. Blue dotted is against. Major minor up in the channel deep. Green on top, and both pointed up. And parallel, not looking like they're going to cross over each other. Right? So there's a lot going on there. But it's evident that whatever this is happened as a result of some type of emotion or new influx of volume and liquidity in the market. Now again, that doesn't mean that it's not going to continue up, right? But I would say be cautious. Be cautious. Because a lot of times what we'll get is some digression, right? And in this instance, by the way, it went up 6.2 pips. So depending on what your take profit was, you could have been just fine, right? Right here, 4.1. And then if we move forward, we can see that it came to about 5 pips and then started going up again, right? So it did continue, right, and didn't go too far against, but we can still see that there was some movement. And other times it's going to be deeper, right? Other times it's going to go completely the opposite direction and continue that opposite direction, right? Okay, so let's look at this one here. And this one's more of a standard type of tweak, right? And we can see, yes, it is, green is pointed down, and now it's pointed up. But you can see it's not as abrupt. It is still acting very reactive, right? Because it's saying, hey, the market just moved up significantly. Now, significant is just compared to, it's relative, right? Relative to the previous candles. Okay, so these previous candles, and that's how the indicators work, right? So these previous, because they're measuring volume and liquidity and all these things, right? So if we measure these candles, this one's good. This one's 7.2 pips, right? That one's a little larger than some of these other ones. Right here, this one's 5.6. This one's 5.2. This one's 3.5, and that's wick to shadow. And then this one is 6.7. So I guess not much different. But that's why we're not getting as an aggressive a tweaking, right? Because it's a little more standard. It's kind of normal market condition, and so these are going to be more reliable type scenarios than you would get when something really abrupt happens, right? I mean, this isn't retracing anything. This candle, right here, is barely being retraced after all of these candles right here, right? So it's not anything really significant that's happening in that candle, right? We're looking at it again from a systematic standpoint. We've got a few things. Thin orange, thick orange is sideways, blue dotted, thick blue is up. So there's two against us there. We're good there, and green's on top, the red's on bottom. So maybe we've got like 3 points against us, right? But And you would think in these other scenarios, we had maybe one against us or none against us, right? But here we've got three against us. But it becomes more consistent because it's not based on emotion, or it's not as reactive. Okay? So we end up getting more follow through from that indication than we would in a situation where it's more based on emotion and the indicators are just acting reactively, right? And we can see we did get a little bit of down right there, 1.5 pips, and then it went up. I mean, it's only 2.8 pips, right? So it's not anything significant. But you can see this would be more of a normal market condition versus what we were seeing, in some of these examples over here, right? And so that tweaking doesn't seem so abrupt, right? It doesn't seem so extreme, especially because although it's reacting to what happened, that candle is not very extreme. It's relatively close to the other candles in size, and it hasn't really broken out of anything that the miners would see as, even like a consolidated range. Let's say that's the consolidated range from this point right here to, even our current candle, right? This is kind of the range that it's been in. It stayed right here, right? So it hasn't really broken out of that consolidated range for quite some time there. And we're seeing that play out within the indicator, right? And you can see it isn't until later that we kind of get that break out of that consolidated range. So that's a more, normal market condition. And let's look at this one here. Now, this one is, obviously going to be in a higher volume time. We can see that we already had that negative convergence, right? That's already softening. We have major minor pointed down, right? And so we get that short movement right here. And we get this tweak in major or in pressure, right? But again, it's par for the course in a situation like this. Okay? And again, if we kind of blow this up, we can see that we're still, not anything too significant has happened. I mean, did this retrace, a few candles? Yeah, this first red one had already retraced that green one. So we're looking at, 1, 2, 3 other candles. So yeah, there is some significance there. And this could also have been caused by maybe some additional liquidity into the market. But this is much more common. We see this much more common and not as abrupt as we were looking at back here, with some of these scenarios, right? And they're kind of regular market condition type events. And in that, we end up seeing that there's more consistency in that at least initial direction, right? And there are some things here that we could still be aware of. I mean, if we're looking at it from a point standpoint, again, we've got everything in our favor, which is obviously not my favorite scenario. We got 1, 2, 3, blue dotted is up, that's 4. We got 4. Now they're oversold, but they just got there. Green's on bottom, red's on top, and they're both pointed down. So although this could easily be right in the middle of something that's normal and something that's abnormal, right? Abnormal in the sense that it just happened as a result of an emotion, not because of regular market conditions. So this is kind of something that's squished in the middle of that, right? Because it could have very well just been caused by, an increase in volume and liquidity into the market versus an announcement, right? Nonetheless, even in situations like that, we'll see more consistency and follow through, right? We could still see some pullback. Nothing is 100%, obviously, and there are things that obviously you want to be aware of, right? I mean, you're getting to a max out point on your thick orange. You definitely have room on your thin orange. It's only at about -50 there. Majors and minor oversold. Minors at that 160, right? And a lot of times you'll notice, and you'll want to play around with this, but when miners get to that 160 and they just arrived oversold, a lot of times majors are not done. So miners might soften out, and there might be a little bit of pullback, but ultimately, a lot of times in this situation, majors after a little while are going to pull it back down. Right? It's just a matter of timing and timing it. And it doesn't necessarily mean it's going to be lower than this point or the lowest point of that candle, but and it may very well just go back to that low point, right? But if you time it, if you're able to time it right, a lot of times you can get that pullback first and then get in on that pullback as it comes down. Now this one just went short, right? That one just went, I mean, it did go up 3.9, and then it went short, right? But a lot of times when that happens, you'll get, a green candle or two, and you may be able to get in on that before it starts to come down. And you'll notice that is more likely to happen during the times that the session changes. So if you're going from a morning session to an afternoon session, sometimes you'll get this big movement and then consolidation, right? And that consolidation is like you'll get, 2-3 candles up and then maybe some down. But a lot of times you can position after 2 or 3 of those candles to take that short. And then if you feel like it's still that consolidation, take those longs. And a lot of times overall, as the evening progresses, you'll see it break out in a definitive direction, right? And sometimes, and there are ways, we won't talk about them today, there are ways that just looking at that sequence, you can, and what the indications were at that point, you can see what the overall direction is going to be, and kind of where that line is actually going to end up. Because you may have a consolidated range here for hours and hours, and it kind of breaks out of that consolidated range, and that's referred to as like a false breakout, right? And then it comes back into this consolidated range, and then eventually breaks the other direction aggressively. And a lot of times, you can get to a point where, just with a 60-minute, by the way, you can get to a point where you can see that. You can see at some point, I'm going to get a false breakout, and that's going to be my opportunity to position for the opposite direction. And then you can ride that sucker. I'm not a fan of riding trades. Some of you guys are. And it's not trading breakouts. I guess in a way it is, but it's not trading breakouts in the traditional sense that you're waiting for it to break beyond a support or resistance level. That's off topic. Nonetheless, we get a more consistent, like we were saying here, we get a more consistent movement in our direction, because it's more it's run of the mill, right? It's not this abnormality, and again, it's kind of in the middle of abnormal and normal. So it's on the low end of run of the mill, but nonetheless, this is a common occurrence during high volume times. So the reason why I'm making that assertion is because I want you guys to be able to, at some point, be able to differentiate the two. Okay, this is obviously an announcement, even not knowing what time it was or if there was an announcement there, but you can just look at it and say, okay, there was something emotional that happened here, and that is causing for the indicators to act reactively. They're now pointing reactively in those directions because of this abrupt movement or change in the market, right? That caused for these to have these sharp pitches, and sharp pitches aren't always indicative of emotional movement, right? Like we can see here, but they're going to be indicative of high volume times or announcements, but they could also be high volume times or new volume coming into the market during market opens and things like that. But after a while, you can tell the difference, and being able to tell the difference is important, because then okay, this is going to be more consistent, and I'm going to be more confident in going ahead and executing in this scenario versus these scenarios, right? And again, don't use perception to determine the two or whether or not you're going to take a trade. Use science and math. You guys have resources to learn how to use the science and the math, right? By way of back testing and looking at those, and determining if they're going to be something that is viable and more profitable. Obviously, if it makes no difference to profitability, or it's less profitable, you don't use it. Even if it makes no difference, because all that does is, for one, it could decrease your frequency, which if you're not accounting for that could very well decrease your profitability, or it could just make the setup more complicated, right? Having more points of validation is not always better for a trade setup. Most of the time it's not. The simplest is usually the best. It's kind of like Occam's razor. The simplest explanation is usually the right one. You start adding all kinds of extra stuff, and you gum up the process, which is the trick in transitioning to a more discretionary way of trading, because there's more that's left to your discretion versus very cut and dry, square peg, square hole scenarios. Now, be warned, if you find that you're very emotional in the market, a discretionary approach is not good for you. It's not good for you yet. Okay? Because, and actually, referring back to Chris and I's conversation yesterday, we were talking a little bit about this, and I've experienced this in my trading. You have these discretionary methods, and maybe it's not to the point where you know where to put the weight, right? Maybe in certain situations, you know discretionarily what pressure is doing, but that may not be where the weight should be placed in that particular scenario, right? Or you're looking at multiple things discretionarily, but perhaps you just took a couple of back-to-back losers and now you're emotional. And now you're letting those dictate whether or not you should pull the trigger. Okay? And that's not pulling the trigger is just as detrimental to putting in, a frivolous trade, just because you got a good hunch or you got a good feeling about it or whatever. It's just as detrimental, right? Especially when you're talking about risk to reward. Because if you've got a risk to reward that's even a 1-to-1, but 1-to-1 or higher, 1-to-2, 1-to-3, whatever, or sorry, the other way, 1-to-1, 2-to-1, 3-to-1, 4-to-1, right, where your risk is greater than your reward, you need those winners. So if you've taken 3 back-to-back losers, and you know that at some point you're going to hit 3 back-to-back losers, you should have more urgency now to put in the next trade that's available, because you need those winners to offset those losers. If you don't take that next trade, right, and it's more likely to be a winner and it wins, you've now missed the opportunity to offset some of that loss. And then that just compounds in your brain, right, in your mind. And you're like, you get inside your brain about it, and you're like, okay, well, I took 3 losers in a row, and now looking back, I could have had 5 or 6 winners in a row, which would have offset that and put me into profit, but now I'm way behind, and now since I just hit 5 or 6 winners, what if I hit another loser? What situation is that going to put me? You understand? Like, it's going to, and the only reason I know this is because I've had these irrational conversations with myself, right? And I've gone, a month or more, I'm not kidding, not placing a trade, but staring at the market until my eyes bled, and even calling trades. Oh, it's going to do this. It's going to do that. Oh, I did it. All right, well, I'm going to put it in a demo account. So I put it in a demo account, and it would do it. My demo account started looking better than my live account, and I'd start kicking myself in the butt like I should have put that in my live account. Right? It's this snowball effect, and it'll eat you up. So if you're not psychologically ready for a discretionary method, even if you are technically ready, in other words, you can read the indicators much more discretionarily, the psychology will win. And if it's bad psychology, you'll lose, and you'll start second-guessing yourself. So how do we make that transition, right? Well, once we feel like we've got some of those things in check, which, by the way, new psychological facets will come up as you develop, especially with a discretionary method. And simply being afraid isn't a reason to not trade, right? I mean, if it's crippling and it's causing for you to deviate from your plan, yeah, hold off, right? Don't deviate from your plan. But if you're following your plan, but you're afraid that you're going to lose, well, that's kind of healthy, you know. But eventually you get over it. It shouldn't be like this fear that is paralyzing or petrifying fear, right? It's you know, it's like it's more like, you know, fingers crossed, you know, when you're sitting there, you're hoping for good, but you know, you don't want bad things to happen, obviously, right? You know, that's okay, and eventually you get accustomed to those things, you get callous to them. But do it, right? And just know that if you get to a situation where you get too far into your head about things, and it's affecting your ability to discretionarily look at the market like you normally would, then default back to your systematic trading. But don't just stop trading, right? Default back to the systematic, the square peg, square hole. Then once you got your confidence back up, then jump back in and start maybe placing some discretionary trades or going to demo in combination with trading live your systematic, discretionary, and demo. Just make sure that you've got a good beat on things. Build that confidence back up and then get back into it, right? And again, don't kick yourself in the butt when you're taking those demo trades and they're winning and they're doing better than your live account. But just let it be a lesson. That's the result of psychology. That's the result of you being in your head about things and not be willing to pull the trigger or do what is necessary. In a demo account, it's easy because there's no consequence, right? You burn a demo account, you lose all. There's zero consequence. You just create a new demo account. There's not a real attachment to it. As much as we try to make a real attachment, there's just not as real an attachment as there is with the live account. Have you heard any updates on Green Chart 1? If we're getting rid of it. I'll find out exactly, Chris, about Green Chart 1, and I know that there's going to be an option to still have it. They've been throwing around some ideas of just charging extra to still have it because obviously Green Chart is not ours. It's something that we, for a long time since the inception of the indicators, we've just used to encrypt the algorithm. And it's like Costco. You buy it in bulk and it's less expensive, where now if we're transitioning to Green Chart 2, we're not going to be taking Green Chart 1 in bulk, which means the cost per unit would increase, so that unfortunately we've passed on to anyone that want to continue using Green Chart 1. And that's not for sure. I'm not sure what the approach is, but I know that they're going to allow for us to be able to continue to use Green Chart 1 if we'd like, and there may or may not be additional fees associated with using Green Chart 1 moving forward versus just using Green Chart 2, where there would not be additional fees associated. Okay, so let's look at this other example here. And again, we can see a very abrupt change right there. I'm kind of pointed up. Got parallel lines. There's no convergence. We got major and minor pointed up in this instance, and then boom, it starts to point down, and we've got very sharp, abrupt changes in direction here and here, and you know, a lot of times when we see that, you know, we know that it's a result of some type of emotion in the market, right? This candle is 11.1. This candle is 18.6. You know, so we can see here that there was some additional volume put into the market, right? And then here, all of a sudden, it just abruptly changed directions. Okay? And a lot of times when we see that, right, if we look at the big picture, right, a lot of times when we see that, we see that there's going to be some pullback. And look, again, it's not always significant. It's 2 pips. It's not much, right? It went down as much as it went up just on that one candle, of course. But you can see initially it wasn't too significant, right? So for you, for the times you trade, the currency pairs that you trade, it may not even be significant. For others, it may be very significant. And so it's going to depend on the individual. And this is, one of those scenarios where it actually just kind of went the other direction. Right? After that abrupt change, then it just took its sweet time and started going the other direction. I mean, that's pretty deep. That's like 21.4 pips, right? I mean, even if it comes back after that, that's still quite a bit to go, the opposite direction. Right? And then, of course, it just continues. So again, even if it started to come back here, right, from this point, because you were certain that it was going to start coming back at some point, it could, but it's moved 61.3 pips to that point. And what if it only came back 30 pips and then continued back up, right? So, obviously at some point it's going to give back. The question is it going to give back enough to take you out profitable? And that's important to remember, because when you feel that inkling to remove your take profit or remove your stop loss rather, remember that. It could very well start going short, but it doesn't necessarily mean it's going to go short enough to go beyond, this level or whatever your take profit is, right? And so just let your trade plan fall as it normally would. So right here we've got another scenario, right? Where we have that abrupt change again. So we've kind of got a hydra going on here. Green is down, red is down. They're, they're side by side. There's no convergence. They're just kind of running parallel, right? And then you get this, look at this sharp, abrupt change in direction. They start to narrow. They start to converge, right? Major and minor went from that hiccup to now, or hydra, to now pointing up very aggressively. Got nothing to the short side, 1.2 pips, and then it went up 31.7 pips to that point. And again, big picture, right? Look at how small these candles are compared to that one, right? So we know that this is something that is, announcement. It's the indicators are now acting reactively, right, to what's just happened. So again, what are the indicators telling you in this scenario? Which, by the way, is why we don't trade announcements, right? Because it could do whatever it wants. But what is this? What is pressure in this instance telling us? Is it telling us to buy? No, not in this scenario. Is it telling us to sell? Nope. All it's telling us is the market went up. It's telling us what just happened. Is that useful? No, absolutely not. I don't need the pressure indicator to look like that to tell me that this candle is green and 31 point something pips. It's reactive. All it did was reacted to what happened. Okay? And a lot of times in those scenarios, you'll get some pullback. Not always, right? But a lot of times you'll get some pullback. So again, we started this by saying this is not meant to try to build a trade strategy off of a trade setup. It's meant to give you insight into discretionary trading. And in this scenario, it did. It went up even more, 14.7, where in other instances it did not, right? This one went up versus down, right? This one went down, well, it went up and down, right? Versus up, and then it went up. The one that we saw before that just went up very aggressively. So which is it? Well, it's all of them and it's none of them, which is why we don't trade announcements. And we don't trade announcements because, again, the indicators are reacting right? They're reacting to what's just happened. They're not predicting what's going to happen. Okay? So it's important to have to be able to differentiate the two. Oh, by the way, this says 5 minute, but it's just because I labeled it. I changed the name to 5 minute, but it's actually a 60-minute chart. All of these are 60-minute charts. And this is, I think I only went back and just found examples in this month, in May. You see May 7th, May 5th, May 5th, May 3rd, May 4th. Okay, let's look. I think I've got one more, and then we'll wrap it up for today, guys. Okay, so right here, this is, you know, another one of those scenarios where we've got, and I don't know why that's dashed. Another one of those scenarios where we've got, you know, so it kind of pulled back down, and then we had this really abrupt change in direction. Look, green is, and they're soft, right? There's divergence. Green is down. A lot of times what we'll see is kind of this sideways type stuff happen, and then maybe some crossing, and then, you know, whatever, right? But right here, instead, after just having crossed, and it's not uncommon for it to cross and then cross back up, but usually it kind of look like that, right? Sideways. And majors and minors are deep in almost oversold. Right? There's a lot going on here that, if we're looking at it systematically, would tell us, yeah, we're probably good to maybe sell a little bit more, you know, maybe to, you know, beyond that or whatever, right? Not trying to say one way or the other, but watch what happens here. And we could very well have sold a little bit, right, before that, and not really. I mean, it only went down about 7.2 pips. But then it shot up 81.1 pips. Is that normal? No. That's not normal, right? 81.1 pips in 1 hour. I don't know how long it took to get most of that. But that's abrupt, right? Look at the rest of this. Look at all of this right here. From here to there, the highest point to the lowest point is 97.6. That one candle did almost most of that, right? Like 80% of that, right? So, you know, you can see that this is abrupt. This is not the standard. This is not the normal, the norm. There's emotion in the market. There's something, announcement or something that happened, right? And as a result, we get some pullback after that. Sometimes it's extreme, sometimes it's not. Relative to that 81 pip move up, not moving 28.9 pips down, that is significant. Only moving about 1 micro pip up. Yeah, if you're in a buy trade there, right, and your stop loss is, I mean, if you're using a 28 pip stop loss or something, you know, greater than 28 pip stop loss, you know, unless you're going for, I don't know, I guess you can, I'm not going to judge you. But anyway, you know, that is significant. That's deep, right? For most of us, that's going to stop you out, right? So, you know, be cognizant of that. And again, it's something that is much more useful in a discretionary method as opposed to a systematic method. So, but it can be used in concert with your systematic method, right? Because then you create a hybrid approach. Even if it's 90% systematic and 10% discretionary, right? You only know this one discretionary thing in pressure, and when that, and you've tested it, you know how it's going to work for you. And so when you see that discretionarily, then you make an assertion on the setup as to whether or not you're going to take it, knowing full well that sometimes you may not take that trade, and it may very well have won, or maybe it's an instance where you would take the trade and take more than you would have normally, and understand that you may take that trade, and because of your back testing and your scientific method, you found that you could get more pips in those situations, and it doesn't give you the more pips. But if your back testing says that long term it's going to work for you, stick with it, right? Continue to use that, because now that discretion is going to lead to more discretion about other things. right? And eventually you start to really understand and be able to read the indicators, and you could still use that systematic method, but then it becomes much more discretionary, and that ratio, that hybrid approach ratio, starts to narrow, right? It's not 90% systematic, 10% discretionary. Now it's like, 60-40 or, 80-20 or whatever. But I want to see more of you guys, the ones that want to, more of you guys have that evolution and start to create that hybrid approach, because it's gonna do wonders for you. You're gonna do things that is gonna blow the lid off of your day trading, and it's not. Remember, because you'll have friends, you'll have family, and they'll want you to teach them all of a sudden, even though they didn't care and they told you you're going to fail. And, your uncle that's never done anything with his life, that, lays around on the couch drinking beer and watching television in his pajamas, told you that he knows all about day trading and it's a sucker bet. That guy, he's going to be hitting you up to teach, so you can teach them what you do. And other people that maybe were genuinely interested, but wanted to see how it was going to go for you, or any combination of any of those people in your life, that you'll get approached and they'll want you to teach them. And I'm telling you, it is difficult. It is next to impossible to teach a discretionary way of trading to someone else. There are way too many variables for somebody that knows nothing or has formal trading experience outside of our indicators. You could probably do better, and it still take a lot of work. Do better teaching somebody that is experienced with our indicators and has a certain level of discretion themselves. But to try to teach somebody that's never traded with our indicators, even if they've traded before, or someone that's never traded before, is virtually impossible. Right? You just got to encourage them to do for themselves and let them go through the process and figure it out for themselves. And some of them are going to fail and say, well, it's your fault because you didn't show me what you do, and obviously you're successful and I'm not, and it's your fault, right? Everybody wants to blame someone else, right? Believe me, I'm speaking from experience. But I want to warn you about that, because it will happen. And just know, that's why I don't teach you guys a lot of my discretionary approach. All it would do is confuse you, probably. Right? And I don't want to do that. I want something that's duplicatable. All right, guys. That's what I got for you today. I appreciate you guys joining us. And join us on Friday for the sweep. And that's at 3 o'clock Mountain Standard Time, 5 o'clock Eastern. And, of course, like, share, subscribe to this video, or subscribe to our channel. And comment on the video if you'd like. And we'll talk to you guys either on Friday or next Tuesday. Happy trading.